Most founders never see what happens after they pitch. They leave the meeting, they send a follow-up email, and then silence. So today I want to open the black box. We're talking about what actually happens inside a venture capital investment committee. No mystery and no hype, and just sharing the truth. So what's an investment committee? An investment committee, or IC, is where a fund decides whether to risk real money, not opinions and not excitement, but actually deploy capital. And here's the context most people miss. Less than 1% of startups ever raise venture capital. And of the ones that do, around 90% don't return meaningful capital. So IC investment committees and the due diligence process exist for one reason: to decide which risks are worth taking. And at Indy Pixel Ventures, our investment committee isn't about getting everyone excited about the deal. It's about pressure testing the decision and the idea before the market does for you. So let's take a step back. By the time a deal reaches IC, it's already past some filters or some due diligence process. We believe in the founder. The problem feels real. There is early traction, insight, or momentum. IC is where we slow everything down and ask a harder question. Are we willing to stand behind this company when things don't go according to plan? Because in startups, they almost never do. And here's what the room really sounds like. One person presents the deal, then the questions starts coming. Is this a real pain or just a nice to have? Why does this team win? No, not someday, but right now. And what happens if growth takes twice or longer? If fundraising gets harder, if a bigger company shows up? Good ICs aren't really quiet. They are honest, straightforward, and direct. If no one pushes back, it's not usually for comfort, but it's actually a red flag about the startup or the idea. So this part here matters a lot for founders, because in venture, there is no such thing as an almost yes. If the room isn't aligned about your company or idea, it's usually a no, not a maybe, and not a wait and see situation. And usually that happens because startups are really hard. And when things get hard, a weak yes disappear fast, and strong conviction beats excitements every time. So here's where things change depending on the stage, and to kind of differentiate between each stage and big funds and small ones. The early stage I see is mostly about people. So can this founder learn fast? Can they take feedback? Can they work with us? Can they survive the pressure of the market? The data's thin, the roadmap will change, and we bet on human more. At later stages, IC becomes more mechanical. In big funds, they look at metrics, benchmarks, and risk models. The questions really shift from can this work to how big can this get and how much return we can get. Both, of course, matter, but they are very different games at a very different stages. So now let's talk about something founders feel but don't always say out loud or share about. When you talk to firms, big venture firms and early stage firms operates very differently. So big funds manage large portfolios, usually for later rounds. They need big outcomes and they optimize for scale. That often means less time per founder and more pattern matching with the market. But early stage firm like us play a different role. We're closer, more hands-on, more exposed. We work with you and alongside you. When things go wrong, we feel it, which is why founder relationships actually really matter for us. So here's my opinion. VC is a long-term relationship, not a transaction. And if a fund can't show up when things are hard, they shouldn't be in your cap table. Early stage founders don't need hype, in my opinion. They need honesty, and they need real support and real conversations. And at Indie Pixels Ventures, we care about how founders think, not just how they pitch, and how to support them to get them to the next level. Because when trust is strong, companies move faster. So if you are a founder, here's how you can help your deal when it gets to an investment committee. First, be clear about the problem. Not clever or be clever, but being clear. And second, own the risk and share about them. Don't hide them. We already see them and we know when there is risks. Founders who acknowledge risks build trust faster. with the venture capital firm that you work with. And third, show progress. Momentum beats promises every single time, whether online or the product. When you do this, you make it easier for someone in the room to stand up for you and say, this is risky, but it's worth the bet and it's worth backing. We do believe here in Individual Ventures that VC shouldn't feel like a black box. When founders understand how decisions are made, they pitch better and build smarter. Transparency creates alignment, and alignment compound in the long term. And that's core to how we invest in our thesis and philosophy. So, long story short, we do invest in underdogs, not because it sounds good, but because resilience shows up early. And IC committee helps us spot founders who can take pressures, learn fast, and keep moving forward. That's who survived the long game in the startup world. So if you are a founder building something real, especially without a perfect background, we want to hear from you. Learn how we invest and what we look for and how to work with us and get our support at IndyPixels Venture. Check the link below, indypixels.co. And if you are an investor or LP who wants transparency into how early stage decisions actually get made, not polished one, come learn more about IndyPixels Ventures, our mission, our philosophy, and our process. Check out the link in the description or the first comment. At Indy Venture, we pride ourselves that we always look for no hype, but really just real builders backing real founders. Thank you so much, and I'll see you in the next one.